Welcome everyone to the last meeting of the RDC Speaker Series for this term. We are really lucky to have Professor Lars how to pronounce your last name? Stentoft?
Stentoft, yeah.
Stentoft, okay.
Yeah.
I always make sure with international people. So, he will be talking about new direction in simulation method for financial econometrics. Come in. And he's one of our new CRC, so we're really lucky to have him for that. And also he's co-appointed with the Department of Economics and Actuarial and Statistical Science. So with that, I will let the guest of honor get going. And also he's one of my good friends, so it's also one of his credentials. So, all right.
Thank you very much, Paul. And it's also, I should let you know it's my birthday today, so, so be nice, okay? Well, thanks for the introduction, Paul, and thank you all for showing up here. It's a great pleasure to be here and talk a little bit about my research. I was told I should stay in the light, so I'll do that. I have 77 slides, and we have about an hour, so we're never going to get through that, but I'll do as much as I can. So there's a brief outline of what I would like to talk to you about. I'd like to introduce this whole topic, talk a little bit about what is financial econometrics and what's specific about that, and then also talk about how simulation methods can come in handy to solve some of these problems. And then I want to go into a little bit of details about how people have been using Monte Carlo simulation to price financial derivatives, financial assets. And I have two talks that I recently gave, one in Chicago and one in Ottawa, and they will form the basis of the last part of it. And we probably won't have time to do the very, very last part of it, but I'll skip through that and make sure that we make it for the bar at 4 o'clock. Or before that. So feel free to interrupt me at any time. I'm happy to explain further any details that you might have. So as Paul said, I'm jointly between economics and statistical and actuarial science, and recently joined here. So it's great to see so many people. So what is financial econometrics? This is basically slides from my course on financial econometrics. Well, it's the study of quantitative problems arising in finance from financial theory. And what do? We use statistical techniques, economic theory, to address a variety of problems. Okay, so we want to build financial models. We want to perform estimation using these models. We want to use those models to do inference with the models. We want to do volatility estimation. We want to calculate risk-adjusted returns. We want to do risk management. We want to do all the things that everybody should be doing in their everyday life, right? More or less. Now, oftentimes, the goal of testing financial theory or economic theory, that could be, or that's what we're going to do. We're going to do capital asset pricing. We're going to price derivatives. We're going to do portfolio allocation. We're going to talk about hedging strategies, many other things. And almost always that involves some sort of calculating the fair value of an asset. Okay? If we're investing, we want to know what's the fair value. If we're risk managing, we want to know what's the fair value of this product and how risky is it. And typically asset values are just basically given as discounted future cash flows. That's all you get from an asset, unless you really, really like going to board meetings or general assemblies and you like to mingle with the people. The benefit you get from owning an asset is the money that flows to you, right? Sometimes you could have other types of benefits from you saying, okay, I got this fancy asset, but we don't think about that so much. So typically we're just going to look at this as a discounted future cash flow. So Monte Carlo methods are obvious candidates for calculating such objects, and I'll explain why we will need these things. And if you come from a statistical background, the nice thing is that averages of random observations will converge to expected values under very, very mild assumptions. Okay, so it makes sense to do these things. Okay, so this is a classical plot. This is the S&P 500 index over time, adjusted close from 62 to 2012. You look at the actual price, and you see a couple of interesting episodes in life where people who were up for retirement lost all of their money because they were all loaded up on the actual asset. So that's the left-hand top plot. The right-hand top plot is basically the returns. So how much would you make on a daily basis? everybody will see the stock market crash in 87. I mean, that's the blip you see there, up there. And then you see what I'm going to call, and what everybody will in financial econometrics is going to talk about, is volatility clustering. So, and I'm going to step out of the slide. These events here where you have very, very high volatility. So that was the end of the dot-com bubble that we had there, when everybody was loaded up on anything that had anything to do with com or dot or tech or whatever it was. And then there was an extremely calm period in between from 2002 and forward, and then things started acting up again in relation to the financial crisis. So these are the kind of things we're going to try and model typically when we do financial econometrics. I've got the density of the returns here, and anybody who knows anything about densities will see, okay, that is completely impossible to see anything from a plot like this, but it does indicate, and of course that's the 20% drop that we had in 87, that these are fat-tailed distributions and they're very, very skewed. You can see that much better over here. Okay, so how are we modeling these kind of things? And I'm going to show you like a very, very ambitious way of doing these things, okay? I think very ambitious. So this is an example from a paper I have with Jeroen Ramboots, a co-author of mine who was in Montreal but is now in Paris. I should say that what I've done is, the slides are going to go online, I guess, in one way or another. So,
and like the whole presentation.
The whole presentation, so references and stuff like that. There are actually references at the end of the slides. That's why there's 77 pages, okay? So what we do here is we have a discrete time model, very, very generally formulated like this. Okay, there's some distribution, and that's really the important thing here. Don't think too much about what actually goes in there. I'm just basically putting these equations up here to motivate why we will not be able to calculate these things in closed form and why we would want to do simulation. Okay, so this is how my distribution looks, and this is a so-called mixture distribution. It's a mixture of something which is known as a Garch model. Some of you might know this. So this is basically a generalized autoregressive conditional heteroscedastic model that models the volatility of a given asset with time dependency. It's a very flexible model that can actually accommodate these features. And what you see is I've got a very flexible distribution, which is basically a mixture of k different distributions, each of them having conditional heteroscedasticity, right? Now, even in the very, very simple case, there's no way that I can start making predictions about distributions of these asset prices more than one step forward with these type of models because of this conditional heteroscedasticity. Now, even more, if I have a model that's this general, I just don't have a hope. There's no way I can hope for actually being able to get any kind of closed form solutions from this very general setup. Okay, so that's basically why we would want to then think about other ways of solving these things. I'm just going to put up here, some third and fourth and second moments of these things to show you how flexible it is. Okay, so that's the background in financial econometrics, is to have these very, very flexible models that we can fit to data, because as you probably saw here, I mean, this is daily data. So I've got about 12,000 observations, right? So that's both a benefit and a curse when you do financial econometrics, is you have so much data, you can fit all of these advanced models. On the other hand, you have so much data that you need very, very general models to fit the data. Okay, so somewhere in between there is where we caught. Okay, so that's basically what financial econometrics is about. This is, well, not what financial econometrics is about, but this is part of financial econometrics. I put up some estimates here of these models, and you can't see anything, and that's actually the purpose of that slide, is to, to show so many numbers that you won't be able to see anything, but you can estimate these models. Are very, very flexible. The question is, what do we do with them, right? So when I started working with Jeroen is a statistician, and he would, have these fancy models. He would put them up, and he'd say, yeah, I can estimate them, and he was happy. And then he came to me and he said, Lars, you're in the finance department and you're an economist, so what should I do with these things? And that's when we started working together, trying to figure out what can we actually use these models for. Okay, so what are we going to do with them? Well, we're going to try and see how these flexible models can help us price assets. Okay, and as I said, to do that, we're going to have to think about doing this in some other way, because there's no way we can calculate these expected values, these future values of an asset that relies on these dynamics, okay? So in comes Monte Carlo simulation. Now, simulation is not necessarily that interesting if you're just pricing your regular thing. It really becomes interesting when you start talking about derivatives, Okay, so I've got a few slides here that's going to introduce derivatives to you guys. Now, best known types of contracts, probably financial forward contracts, so futures. We also have options, and my talk is going to be primarily about options. And these are these beautiful instruments that have, at the core of them, what they do is they transfer risk from one party to another, from a party that does not like the risk to somebody who wants the risk. Okay, now. The price of these products is then the price of transferring that risk, right? So that's why it's important to be able to calculate these things correctly. Now, what is neat about these things is that, and that's what's neat about finance, financial econometrics, derivatives pricing, is that there are so many good stories to tell. And we don't have time to talk about these stories, but if you Google the biggest trading losses, there's a site, there's obviously a Wikipedia site for these things that is continuously updated whenever somebody else decides to go and speculate for somebody else's money and lose the equivalent of $8.706 billion, speculating in credit default swaps or speculating in index futures, gas futures, interest rate and equity derivatives, CDSs, copper futures, FX options, oil futures. 9 of the 10 biggest trading losses were made with financial derivatives, right? A lot of good stories if you're teaching these things, right? So there's a lot of stuff to look at, and of course there's a lot of interest in actually getting good ideas about how we should price these things. Quickly, what's a future? A futures forward contract specifies the buying or selling of an asset in the future at a given price. It's a very, very simple product that allows you to shift the risk because it basically allows you to completely hedge the risk that you have in these things. So they carry with them the obligation to go through with these transactions. They're powerful to hedge and modify portfolio characteristics. How are we going to price these things? As I said, financial assets are always going to be priced as the expectation, right, of some payoff. So that's the payoff that you get from a futures contract. If I buy the asset, okay, I can sell it in the future for a price of S. And then if I've committed to actually, I could then commit to actually buying that asset at a futures price of F. And then buying it for F and selling it for S is going to give me this profit here if that's positive. If it's negative, it's going to be a loss. And if I discount that back, so think about MT here as just a way of discounting future payments back to today, I get the price of these things, okay? Now, it's not really important. I don't want to talk a lot about financial theory and how you're going to price these things, but you see that these are simply priced as an expectation of some future payment. So it's going to be rather important. Now, we'll spend a little bit of time on just talking about options because they're so important for the rest of the talk. Okay, so for those of you who are familiar with these things, you can sit back and have a cup of coffee or whatever. And for the rest of you, this is a crash course in option pricing or in options. An option is the right, but not the obligation. I mean, it's an option to buy or sell the underlying asset at a specified price during a specified period or at a specified time for a given price, okay? Some notation here or some vocabulary. Buying and selling at the asset is called exercising the option. The price that you trade at is the exercise price, and the latest point in time at which you can trade is the maturity of these things. Okay, so you got 2 types of options, call options and put options. Call option is the right to buy the underlying asset. Put option is the right to sell the underlying asset. The easy way to think about these things is think about the put option as an insurance contract. Okay? So you own the asset, you buy a put option on that asset, and that guarantees your minimum value in the future, right? Because if the value of the asset decreases below the exercise price, the put option starts having value, and that's going to cancel out the losses that you have. This is how it looks. This is a payoff plot of these things, right? So the red line is a call option. It has a strike price of $100. If I buy the call option in the future, if the underlying asset ends up at $120, I can now exercise my call option, buy the asset for $100, go out in the marketplace and sell it for $20 or more, $20 more, $120, making me a profit of these things, right? And that's how you think about a put option as an insurance contract. If your asset decreases in value, the put option will then pay off. What do we need to price these things? We need some sort of distribution over future outcomes of stock prices. And then what's the price of these assets? It's basically basically just the integral under these payoff values with respect to this density, and that's a price. Okay. Now, if I know what the density looks like, and for those of you who are familiar with these things, this is a log normal density, so this is the Black-Scholes world. So if I had invented this, I would have gotten the Nobel Prize in economics, right? Way, 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 way back. Okay. So basically what you need to do here is you need to figure out, okay, what is the value? How often do I get a payoff of this? And you've got the density here. Okay. So what will simulation do for you? Simulation will randomly draw future assets with this distribution in situations where you can't calculate that distribution in closed form. Okay? And then what you're going to do is you're going to look at each of those draws. They're going to give you a realization of the future asset price. With that, you can calculate the payoff. And if each of those simulations are independent, you basically just take the average of the payoffs that you get from these things. It is ridiculously simple, right? It's beautiful. It's simple to do if I have European options. Boyle did that back in 77. People were probably using it way, way before that. Now, it's very flexible. Now, I like to say that, have any of you ever seen The Cowboy Way, the movie The Cowboy Way? No? This is Woody Harrelson in the movie The Cowboy Way. No, you don't know it? Okay, so Woody Harrelson and Kiefer Sutherland, it's a pretty good movie. So they go to New York because one of their friends have been, mixed up in some sort of drug deals or whatever it is, and they're going to go there and save him. It's got nothing to do with, a cowboy always takes his hat off when he meets a lady. It has to do with what Pepper says, and Pepper is Woody Harrelson. He said at a certain point in time, they're at a disco in New York. He says, if it's got hair, I can ride it. If it's got beat, I can dance to it. Simulation methods are basically a bit of the same thing. If I can simulate it, I can price assets. Okay? If I can simulate the underlying dynamics, I can price these assets. That is easy if I have what's known as a European option. A European option expires and then you realize your profits. American options, on the other hand, and other types of path-dependent options allows you to choose along the way. And this is really what complicates matters. So I'm going to talk a little bit about how you can do Monte Carlo simulation and price these assets. Now, luckily, we've come a long way since John Hall, who's a specialist in this derivatives pricing, said that you cannot use Monte Carlo methods to price options with an early exercise feature. Okay, now, what I'm going to introduce to you is regression methods. Actually, I think yeah, so these slides are definitely not the right place, but that's because of a mix-up this morning. Basically, Scientific Workplace broke down and didn't want to compile my slides. So we'll get back to these slides later on, okay? So just a quick outline. What I want to do first is I want to discuss how we can do Monte Carlo simulation for these type of options. Then I'm going to come back here and talk a little bit about what else you can do with these products. And then I'm going to provide some results from an application of these things, and we'll try to, along the way, of giving you some sort of outline of a few conclusions and some open questions that we might have. Okay, so if you're a finance guy, this is how you're going to set up these things. If you're not, don't worry about that. We don't really need to think about these things. But what we need to think about is, let's suppose that I have, again, what's known as an American option. So an option that could be exercised at any given point in time. Okay, then there is some strategy for when I should exercise this option. Let's call that tau. Okay, if I know what tau is, if I know how to figure out what tau is, the value of that contract is simply the discounted value of what I get in the future under this distribution that I can simulate, discounted back to now. It's as simple as that. The tricky thing is to decide what this tau is going to be. Okay. Now, I could say, well, why don't I just maximize over tau along a given path, similar to what I'm doing here, which, graphically would look like this. I've got a simulated path of stock prices, and if I'm here, this is for a call option. So basically what I have here is I have a strike price here, so would I exercise at any given point in time? If I think about this as knowing the future, that's obviously not fair, right? It's going to give me biased results because I'm always going to make the perfect decision based on future knowledge that I don't have. I can't have, decide on whether I should exercise or not based on future knowledge. So that's a well-known thing back from from the good old days of Brody and Glasserman. Now, what is here is we have some sort of idea about when to exercise these options. I mean, a call option, again, is the right to buy an asset. Okay? Now, you would want to exercise that when you get into what's known as the optimal exercise region. So if the stock price should ever go above this region here, you're going to exercise the option. Okay? And why are you going to exercise the option? Because in this model, the expected value that you get from holding the option is less than what you would get from exercising it right now. Okay? I'll be more specific about that. We know theoretically that they look something like this. We can show these things. We don't know exactly how they look, right? And that's really the tricky thing. Now, again, the optimal decision, as I said, is going to be at a given point in time, should I exercise it? Which would give me this value here. So if you go to notation here, exercising the option is going to give you a set of whatever. Keeping the option is going to give you the expected value that the option is going to have next period, right? Discounted back one period. So I should exercise if this is bigger than this. Okay, and if not, I should leave the option there and I should wait until next period. I should revisit the decision. It's basically the same thing. If I get outside of here, exercising the option is worth more right now than actually holding the option. The tricky thing is to figure out what this is, what that expectation is. The tricky thing is to figure out how this looks. Okay? So how can I do that? Well, there are a bunch of different models or methods that you can use for these things. I'm going to go quickly through these different things, and there's going to be some references to these things. You could try and parameterize the stopping time. Okay, how are you going to do that? Well, you know it looks like this. Okay, so let's specify a function that can mimic these things, and let's start optimizing over that function. Okay, and if I do that, let's assume that it depends on some parameter theta, so I can then solve this problem optimally. At least in theory, I can do these things. Okay, it's pretty simple if I have this with only one early exercise point. Let's say at T2, one exercise point, I just need to figure out what that number here is. If I have a multitude of exercise points, I need to figure out the whole frontier. It's kind of tough. And it's a very, very nasty optimization problem, right? Because I'm going to have a finite number of simulations, and everything is just going to be discrete. Nothing is going to be continuous in whatever choices I have. Unless I put a lot of regularization on it, I basically can't do these things. People were doing that back in the days, trying to solve these things. Okay, and it's completely unclear what happens in higher dimension. Okay, what else can I do? Well, the trick really is that if you look at this, what I need to know at a given time point here is what do I expect to have in the future. Yeah. Now, I told you that these expected values you can simulate. Okay? So why don't I just, at every given point in time, wherever I am, why don't I just run another simulation? Yeah? And that's actually what people have been doing here in the second idea. So Glasserman has a description of these things. The problem, of course, is what's known as the curse of dimensionality. Right? I'm going to have maybe 100,000 simulations, over 10 different points in time. At each of these 100,000 simulation at each point in time, I need to run another simulation. Things just explode between my hands. It's very, very tough to deal with. Okay? The number of paths will grow exponentially. It's really, really tough to deal with. Okay? Okay, so what about a third idea? Well, what if I start bundling up future simulations? We're getting to something we can actually use now because we don't need to simulate more. What if I bundle up future realizations and I say, okay, these are all pretty much the same. These are all pretty much the same. These are all pretty much the same. Then I have an idea about how many times I move from one point to another point. I can get like these transition matrices if I want to talk about that. And I can start thinking about future values as just being future values in a given bundle times the probability that I'm going to transition into that bundle. Okay? I can do that. That's probably pretty neat. That was actually one of the first suggestions that was ever given. Okay? It works pretty well, but of course you can do a lot more than these things. Okay? So there's a fourth idea. What if I know the transitions? Then I can actually calculate these things. The bundling algorithm here is pretty neat because what is that really doing for you? Well, bundling algorithms really do a little bit of, you could think about these as doing some sort of regression. Right? They regress on future paths and they say, okay, which bundle are you in? And then they're very, very simple regressions where you just get you basically just have a constant for each of these bundles. So that leads us to the last part of these potential models that you have, which are based on regression. I mentioned, the three obvious candidates or references to these things. This is stuff that came out of a talk also, so it's a little bit dated here back in 2011. We still had Google at that time, so you could do Google Scholar. And you could figure out what are people actually citing, right? Now, the interesting thing is here that the paper by Carrier at that point had 218 sites. The paper by Tsiklis and Van Roy had 250 sites, and Longstaff and Swartz came in with 1,295 sites. Okay? By far the most important thing, because they sold it a little bit better and they had a lot of finance stuff in it. So it's all a little bit of a marketing gimmick for these people. What these models do or methods do is very, very simple. They do linear regression. I'll show you how this is done. Okay, so think about this is the equation that I put up before. I need to figure out what to do today. Should I exercise or should I hold the option? Okay. To do that, I need to figure out what this conditional expectation is. And everybody who's ever done a statistics class will know that linear regression is basically all about, or regression is all about calculating conditional expectations, right? You've got a left-hand side variable y, you've got some observable x's, you're going to do the regression, and what it's going to give you, it's going to give the expected value of y conditional on whatever x that you observe. It's as simple as this, right? That could give you, back in 2001, that could give you a publication in RFS, which is a top 3 journal in finance, okay? I wish I had been younger, right? To do these things. So think about, how to do that as simply saying, okay, the left-hand side is my dependent variable, that's this, discounted future cash flows. I'm going to regress that on my observable, my state variable, my x is here, or transformation of these things, because I don't know how that expectation looks like. So I'm going to use a very, very flexible functional form, and then I'm just going to run that regression. That's all there is to it. Now we've gotten an algorithm which is easy to apply, can be used to price these relatively complex instruments. Okay, how does it look? Okay, so think about this as I've simulated a bunch of future asset prices here. I have an option, and then I'm going to look at how these approximations are going to be. These are basically the values, right? So what you see here is future stock prices, and then the value of actually having an option at that stock price if you continue to hold it one more period. This is the true value that I'm trying to approximate. It looks nice, right? In this situation, I know how it looks, but typically I don't know how it looks. I know how it looks, but I don't know exactly what it is, okay? You get the difference between these two things. I've got an idea about the shape of this thing. Now, when I start running regressions with just a constant term, well, obviously, it's going to give me a constant expected value. If I have 5 regressors, so I've got my constant term, I've got 4 polynomials in there, so x squared, x to the power 3, and x to the power 4, okay? I'm going to get something that looks like this, okay? And if I have 10 regressors, 5 means x up to x to the power of 5, okay? Here I've got 10 regressors, here I've got 15 regressors. I get better and better at fitting these things, right? Okay. That's all I do when I do these simple linear regressions. If I'd had a step function here, stepwise function, I could approximate these things, and it would be exactly like doing the bundling that people were suggesting in the early days. Okay. Okay, so this is just summarizing the different models. So I talked about bundling. This is another type of bundling. The parametric method is the one that determines the early exercise strategy parametrically. Now, what I want you to look at here is basically just think about this as an efficiency plot. Okay, I've got root mean squared error, so a measure of how imprecise my estimates are of these prices, and I've got time out here. Okay, so I want to be down here. Down here means no error and infinitely fast, okay? So anything that's on curves like this towards the origin is better, okay? What I see is that all of these things that are down here are my triangles, which is my regression model. So there's always a regression specification that dominates these other models, okay? So there's really a lot of good reason to focus on regression methods, and I think that's in part why people are doing these things. And of course, one of the nice things, and I'm going to go back here to this plot here, these slides here that were wrong, is that it's also very flexible, right? Okay. Now, I'm giving you, and even though we might think about these options as being complex, they're really the easiest possible thing you can think about. I mean, there's one decision, exercise or not. There's so many other applications where you can think about it in the same way, and where you can use the same type of solution to these things. You can do hydro plants. I have an example here where we look at a very, very simple hydropower plant, okay? So these are Quebec researchers, so it's a water dam, water flowing into the dam. Should you produce electricity, sell that? The thing here is that whenever I decide to sell electricity, I'm using water that I have stored behind the dam, so what I can do next period depends on what I did the previous period. You can solve these kind of problems also. If you don't want to think about this as a hydro dam, think about this as an investment decision, right? You've got some money in your bank, you've salary flowing in, that's the water flowing into your bank account. Should you spend it? Should you whatever, right? Similar type of decision. Now, this means that some of the stuff that's going on, some of the stuff that you're making decisions on is exogenous, the price of electricity, okay, the price of power. Some of it is going to be endogenously determined because that's the water, how much water you have. Now, these simple, sorry about that. These simple regressions that we had before are now going to look really, really cool, right? Because this is basically 3 independent regressions depending on what you did last period, okay? So what is the value today depending on did you sell, did you buy, did you do nothing, okay? You're going to have surfaces, regression surfaces that are going to depend on the water level and the power price. That's the 2 things that goes into your decision. And the surfaces are going to look different because it depends on where you came from. Okay? But you can still maximize, and it's a bit tough to see what is actually the top in here. But there's going to be a region where you sell, there's going to be a region where you do nothing, and there's going to be a region where you actually buy water to put in your dam, right? Or buy water in the sense that you use electricity to pump water back up in behind your dam. Okay? So you can solve these problems. Okay? It's extremely flexible framework. Now you also have, and I'm terribly sorry for skipping back and forth, you also have very good ideas about asymptotic properties of these methods. Yeah, it's nice to know that in the limit these things are going to give you the right price. Right? Monte Carlo simulation, we know that. I told you that if you're just calculating the expected value as an average of future realization, that's going to converge under very mild assumptions. Here you can show that as you add simulations, even in this situation where you actually make a choice, as you add more and more simulations, you're going to determine the appropriate approximate value of the option value. And as you get more and more, so simulation is again the random numbers that you generate. Regressus is the number that you use to approximate the decision. As you approximate the decision better and better, eventually you're going to get the proper decision. And under certain assumptions, when you increase both the number of paths and the number of regressors, you actually get convergence to the true value. Okay? So theoretically, there's some good reasons to use these methods, right? I mean, they do converge. Finite sample properties, we've studied that in details also. The method works surprisingly well. I've tried that. Many people have tried that to find something that beats this simple linear regression. Those of you who teach statistics will know, you put up a linear regression, it'll do the trick. It's a massive, it's like a tank, right? It'll do the trick for you. It's very, very difficult to find something which is going to be a Ferrari that's going to perform a lot better in these situations, okay? So it's very, very tough to improve on, though we've tried that. And if I have time to do that, I will actually talk to you a little bit about something that will improve on these things. Okay, so with that background and time, just flashing forward, I'm going to go straight into one of the applications. Okay, so think about this. We've got this black box pricing tool that we can use. Why don't we put it to the test? Why don't we try and do something in a very, very general specification where you just, we try and do as much as possible. Okay, so my idea here was to do all the options on assets in the Dow Jones Industrial Average. Okay? The Dow Jones Industrial Average, 30 stocks, industrial stocks, is the average of those things. It's the most traded industrial stocks in the US. If it's the most traded, it's also going to be one of the assets that has the most options written on it, because it's basically, the stuff that we think about. Okay? So what I did was I took 11 years of data. Yeah, but you stopped in 2006. I agree, I stopped in 2006. That's when I started the project. It takes forever to update these things, right? I would love to do these things, but I'll have to hire a research assistant to do that. I'm sorry about that. It's just way, way, way too cumbersome, right? I've got 140,000 options, okay? Massive number of options. And I'm going to use 15 different models to compare these 30 stocks, okay? So I've got 450 models that I'm estimating and that I'm using. And I'm actually not pricing 140,000 options. I'm pricing 140,000 options 15 times, right, with 15 different models. Okay, it took 2 weeks to run this on my computer. So this is just what we get out of these things. I'll actually get back to that, so don't think too much about these things. This is from a presentation that I gave. When you have 20 minutes to give a presentation, it's nice to get the conclusion up there on the first slide. So if you don't make it, you actually have talked about the conclusions. But I'll make sure that I make it here. What are the dynamics of these things? You'll recognize this from the model that I had before. So I've got some returns that evolve according to there's some stochastic stuff going on here with my epsilons. My epsilons are drawn from a given distribution. And there's going to be some dynamics for how they evolve through time, both in terms of the mean and in terms of the conditional variance of these things. Okay, so it's a very general framework. It allows for very flexible specification of these things. Now, I'm going to price options, so I need to figure out some way of actually figuring the dynamics I need to use for these things. This is how they look. The GLRNVR is the generalized local risk-neutral valuation relationship. So that's going to be on the test at the end of the class, what that actually means. Basically says, well, if the world looks like this, this is the dynamics you should use to price options. So they look very, very similar. The only thing is that there's a little bit of trick here, a little bit of a transformation of things here. So error terms look a little bit different. Okay, that's not a problem because we can simulate these things. Okay, so how are we going to simulate these things? We're going to look at this bugger down here that we need to approximate in some way. So there's a transformation of some innovations here. And then there's an expectation of that actually, and then an expectation, and then some logarithm here. Those of you who are statistics freaks will know that what I'm actually looking at here is a cumulant generating function, TIBOV, but with a distribution that I don't really know what it looks like, so I can't really get at these things very easy. But I can simulate I can do Woody Harrelson, right? I mean, if it's if I can simulate it, I can price it, right? I know that this is a random normal variable. I can calculate that. This is the CDF. It should be actually, the CDF of a standard normal distribution. And this is going to be the inverse of the CDF of whatever distribution I'm looking at. Okay. Now, if lambda is 0 here, this is basically just a quantile kind of transformation of these things. This is how it looks, right? This is if my distribution is actually Gaussian, it's just a straight line, right? When I start adding kurtosis to my distribution, the n starts flipping up and down. It's just a QQ plot. Quantiles of the normal against quantile of whatever distribution I'm trying to approximate, that I'm using here. These things are easy to approximate, right? How would I approximate them? I just run a linear regression, right? Linear regression, powers of whatever set I draw, transforming them into the distribution I need. Okay. That's easy. What about the other thing? So that's this expectation here. Now, luckily, everything is known. It's just a simple function of some realizations of a distribution that I don't know, but I can simulate, times different levels of conditional volatilities. As I said, this is kind of like a cumulant generating function. This is how it would look in the Gaussian case. How does the cumulant generating function look for the Gaussian case? Another question for the audience. This is a standard normal situation, right? So it's basically just going to be 1/2 sigma squared, right? The log of that. Okay? It doesn't change that much when I start having different distributions, because really what it's after is an expected value. Expected values will not change that much. It does change a little bit. Now what it is it's a nice and smooth function in my underlying volatility. Okay, so how do I approximate these things? I run a linear regression and use that to approximate these things. Now I've got 2 linear regressions that I need to do to approximate these things, and then I can simulate these future numbers, and I'm going to do this 3rd linear regression at every point in time when I start to determine the value of this option that I'm looking at. Okay, so now I can do this. I can simulate these things. Okay, I can estimate all the parameters. It's pretty straightforward to deal with, and I can start pricing these assets. This basically sums up that regression-based method that I talked about before. Initialize payoff at each point when you can exercise. You think about, should I exercise or should I hold? You perform a linear regression. You make the optimal choice. You move back one period. This is just the dynamics of it. There's no need to actually spend more time on that. Okay, this is the typical plot. 30 stocks. It's not really interesting. This is the Schwartz information criteria if you want to pick between the models. Okay, turns out that all of the models are going to pick model 13, which is, luckily my favorite model. Okay, it's the one that I've been using, so it's nice that that's actually the one that's actually being picked out among the 15 models. Now, if you want to have some estimation results, this is how it looks if I start estimating these things, and again, it's on purpose that you can't see anything. If you want to, look at the paper or have a look at the slides. Okay. Okay, so what happens when I start pricing these things? Okay, so I've got 30 assets, I've got 15 different models. These are basically root mean squared errors, according to some metric of pricing errors. So in each stock, I've got somewhere between 2 and 20,000 options. Okay? I look at all of those options, all of my models. I calculate the difference between the observed price, my estimated price, my simulated price. I square that. I take the average of that. That gives me and then I take the square root of the average, and that gives me the root mean squared error. And then I look very naively, I look at the model that's the best and the model that's the worst. Okay? And the models grow in complexity as we move from 1 to 15, more or less, in groups. So this is the very simple model. This is a little bit more, this has constant volatility, so this is kind of like the Black-Scholes model. This has a little bit of time, this is time-varying volatility, but it's Gaussian. The next 3 models have time-varying volatility and are fat-tailed, and the last 6 models are skewed and fat-tailed also. Right? The worst model is always the Black-Scholes model, right? So it's a good thing they got the Nobel Prize. I mean, the model, we knew that. That's not really fair. Yes?
Question. So when you say best and the worst, are we talking about big differences between them, or like significant but relatively small differences?
Perfect question. Perfect questions. These are just point estimates, right? Mm-hmm. I have no idea when I plot these things or give you these things. I have no idea if one is statistically better than the other. But I'll get to that. Okay? It's like you've seen the slides already, but I know you haven't. Okay? So I can rank these models and I can look at them like this, and then I can pick the best or the worst of these things and say, okay, yeah, no, I'm happy about these things. Luckily, the best model, again, across everything and pretty much all the time is model 13. So lucky 13 to a certain extent, but that's just by chance. The 13 is my favorite model. This I'm going to skip. Okay, so how do I test these things? You can actually do that. You can use what's known as the model confidence set. Okay, so most of you know what a confidence region is of a parameter. Model confidence set is a confidence set for models, forecasting models. Okay. So what you do is you take all these models with the forecast, and then you look at those model forecasts, and you start doing statistical tests on those models. You use a criteria for if any of those models, let me rephrase that. You use a criterion for if those models perform equally well. And if they're not equally good, well, one of them must be worse than the other ones. You pick the one that gives the worst result. You throw that model out, you retest. Yeah, it's as simple as that. At the end, based on the criterion that you use for rejecting model and kicking models out of these things, you're going to have a confidence region of models, just like you would have a confidence set, I should say, of models, just like you would have a confidence region for a parameter. And that's how you're going to do these things. And now this is my favorite slide. So some of you are nodding a little bit, but please nod a lot. Okay? So what I have here is, because it basically didn't fit on the other side, okay? What I have here is my 30 stocks, and I've got all my models here, and a little star means that the model is actually in the model confidence set. So all the models that are not starred here were significantly worse than the best performing models. All right? So you can do this, you can test these things. And what comes out of it is model 13 is almost always in the model confidence set. Okay. Model 1 is never in the model confidence set. Okay. Some of the models are there for some of the stocks.
Model 7 is almost as good, right?
So model 7 is almost as good, and that's because it's like model 13 but without the skewness. Skewness is not that important for individual stocks.
Where's the Black-Scholes?
Black-Scholes is the model number 1.
Okay.
Yeah, always out of the model confidence set, always has the worst performing, the largest pricing errors, and pricing errors that are so big that they're significantly worse than the next best model. Sometimes it's very tough to distinguish between models. Like for, what do you have here? You have Ph.D. What's that again? I forgot that. Anybody know that?
Home Depot.
Yeah, Home Depot. Okay, so Home Depot is basically one of these weird stocks where there's, none of the models are like very different, except for the Black-Scholes models. The Black-Scholes model is always out of there. But all of the other models are basically equally well from a statistical point of view. Okay, but one of the depressing things might be that of the 450 models that I looked at, 183 of them are actually still in the model confidence set. Okay? So I can't reject a lot of models. I can reject quite a few of them, but not all of them. Or I can't really end up with having just one model that's the only one in the model confidence. Now, what I can do is I can start slicing and dicing my data. I can look at put options, I can look at call options, I can look at options that have short maturity, long maturity, very long maturity. I can look at options that are on the left side of the distribution, on the right side of the distributions, and so on. What you see is it doesn't matter how you slice and dice things, Black-Scholes model is never there. So basically this is how many, across the 30 stocks, how many times a model is actually in the model confidence set. Okay? So model 13 is in the model confidence set for 29 of the call options and for 26 of the put options. Okay. The best model is the model that's most often in a model confidence set across the 30 stocks, and that's almost always either model 13 and model 7. It actually is always model 13 and model 7, and it's never any of the other models that are actually most often in the model confidence set. Now, if you want to get some details out of these things, look at the number of models that you have in short-term options, 174, which is by far the lowest, and when you have out of the money and deep out of the money options. So if you think about these things as the option that are really, really sensitive to what happens in the tail of the distribution, that's where you can distinguish between the models. In the middle and in the middle to long maturity, it's very tough to distinguish between these models. And the reason is that when I start simulating, generating these future distributions, the center of those distributions basically look the same. It's really what happens in the tails. Okay?
And that's just for the Dow Jones. So if you take the S&P 500, it will...
So I could do... So what do we want to do? We want to do even more underlying assets than the one in the Dow Jones. We want to do other types of distributions. We want to do more extensive specifications. My argument here is that this is such a flexible framework that we can easily do these things. Okay, it's very, very easy to do this kind of analysis. Okay, so just a conclusion here, again, that we didn't talk about before. We got 15 models, 30 stocks. I find that I should have a model which has non-Gaussian innovations, so I have to depart from with the nice little toy example with Gaussian distributions, and I should definitely discard the constant volatility model also, and I can test these things, and then I can actually get to a point where I have some statistical arguments for this being the best models. Okay, see, now is when I wanted to talk about improved Greeks for American options, but being that I only have 10 minutes, that's going to be a little bit tough. What I will talk to you about just very, very quickly is plots like this. Remember that early exercise barrier that we had before when we talked about a call option? This is for a put option, so it's just the same thing, but it's just the flip side of it. When would you sell? Well, you would do that depending on what the prices are, right? I mean, so this is all for $40. So think about, what does the put option give you? It gives you the right to sell for $40. What is the profit you make? You make profit when the underlying asset is below $40 because you can go out in the marketplace and buy it back for less than $40, right? But when you're very, very close to maturity, you will only sell, well, you will actually sell if it's just slightly below $40, right? That's the intuition. If my option matures in 1 second and I can sell the asset for $40 and I can buy it for $39, I should do that right now, right? Because the chance of the stock price within 1 second decreasing or bouncing more is very, very low, right? So that's why, you know, you would actually exercise this. But this is just how it looks. This is what you would get if you start calculating these things with the approximation, the simple linear approximations, OLS regressions that we talked about. You get something that looks a little bit like the same thing, right? But so this is an option that matures in 2 years, and this is the option that matures in 1 year. What happens is that when we're initially thinking about this, there's a lot of jaggedness here. I mean, there's a lot of, you know, we're very uncertain about the decision we're making. Okay? That's, of course, when I start valuing these assets, if I'm uncertain about what I should do, that's going to give me uncertainty about the value of these things, right?
But why is there more variation at year 1 and year 2? Is it like psychological? Or?
No. So think about this as an option that actually matures in 1 year. So this one doesn't continue here.
Okay.
So these lines here go all the way up there, but this is for an option that actually stops at that point in time. So this is another option that stops, or that matures in 2 years. And this is how far we are from maturity. So this is when you start with the 2-year option. And in 1 year, the 2-year option is going to look like the 1-year option, but you know, that's all there is. And then there's some high volatility here and some low volatility there. So the more volatility you have, you know, the more, the more jaggedness things also come. So where does that come from? I showed you these very, very nice plots about how good I am at actually approximating these functions, right? And that was because I had a lot of data. Now, I want to show you a little bit about what actually can go wrong. Okay, so this is, the green line is what I'm trying to approximate. Now I have less data. It's not perfect as it was before with a lot of data. Now I'm trying to approximate that with a third order polynomial. That's the red line that you see on the left. Right? So what I do is I get a reasonably good approximation, but not all over. Right? I can't fit the entire curve. What happens is that to fit well here, where I have most of the points, I'm going to lose some fit out here. Yeah? That's what's going to lead me to have all this jaggedness. The fact that I'm not fitting it well all over it. Okay? So that's why let me see if I can get back to this. A small movement here is going to change my decision. That's because I might actually, right here, I'm approximating it quite well. But then if I move a little bit further, I might actually make the wrong decision. Okay? So what our idea here was, let's put more structure on this problem. Okay? Let's impose, you know, whatever constraints that you can have on these functions. One thing you know about these functions is that it's always decreasing. It's monotonically decreasing. Okay? So imposing those constraints, and that's what we do in the blue line, actually gives you a better fit. But what's more important is that because of the restrictions that you have on it, you never get this curving up here at the end because you're assuming structure on the problem. Yeah, you underestimated here the true value, but it doesn't matter because you're making the right decision. You know? Remember, the decision happens whenever the estimated line goes above or beyond the blue line. Oh, sorry, the black line. The black line is exercising. The blue line is holding the option. As long as I'm on the same side as the blue line, I'm good. Right? Now, in simulation, what you would do instead is you would get a better fit here. You would increase the number of regressors. Right? Look what happens to these problems. I mean, this is not a problem with least squares. This is a problem with overfitting. Right? I'm fitting the data much better, but I'm not fitting the function a lot better. I still do that if I impose structure on my problem. Okay? This is, I think, one of the few things where you can actually, so the thing here is that you can do this theoretically, right? You can say, I know how that function looks. You can use economic theory to impose the constraints on these things, and you can actually get something that works better. Okay? I think I'm going to stop here because I'm running out of time, but there's a lot more plots here that you can have a look at. I just want to finish off with this. This is a quote, a little bit from Felling Boyle, who, remember, was the guy who did simulation back in the days of the 1977. He said, well, it's all very nice that you go out and you try pricing these options, but that's just like falling in love, right? You do that once. And if you really want to stay married, you got to hedge the risks of these products. And you can do that with these methods. And I think that's a perfect time to stop.
Okay. Well, that was brilliant. Since there's no a couple of questions, one thing I want to do is to move the group to the grad club as quickly as possible. So let's take one or two questions and then let's get rocking. Yeah.
This one?
Yeah, I'm just curious, are there any statistical benefits of using your complicated constructed least square method against simple Black-Scholes model? Like, I don't see a huge difference between...
So this is the toy example where I know what the true value is. So in general, I don't know, I won't know what the Black-Scholes price is. But I can use this as an way of motivating why imposing structure is going to be better, because it's going to get rid of all that jaggedness here. All that variability here. The non-monotonicity is really what I want to get rid of. And that's going to help me when I start pricing these things.
All right. Anyone? Anyone? Okay, I will meet you. Oh, sir.
Lars, you mentioned in one of your slides that you couldn't really write down or calculate any kind of standard error, if you like.
Mm-hmm.
But you have you have millions and millions of simulated points, of which produce the average that you put on your screen.
Yes.
Can you not use those to create a measure of uncertainty?
So I could, if I'm looking at my prices here that I get, these numbers here, all of those is basically this is an expected value here, and there's going to be a standard error on those things also. And that's going to show you that I actually did that. The editor of the journal asked me to do these things. And basically what that's going to tell you is that because you have so many options, it's going to show you that anything that's not 0 is going to be significant. So you're not earning anything with that. It's just going to tell you, yeah, you were wrong. You can't use it for ranking models because statistical significance in this situation is not the proper metric for ranking those models, because they're all, what is it that they say? All models are wrong, but some are at least useful. So what you're after here is really the most useful model, not the one that's true necessarily. Well, you would love to have the one that's true, obviously, but you can't hope. In this parameterized world, you can't hope for having a model that is the true model. I make no illusion that I'm finding the true model. I'm finding a model that's better than the other choices. And that's really what you get with the model confidence sets when you start looking at these things in terms of...
Is that Hansen, the Chicago Hansen?
No. It's not. It's previously Stanford Hansen.
Okay.
Now, but you're right, it's good Danish names. Yeah.
Plus, if you knew the true model, you wouldn't be here today. You would be the richest man in the world, right?
That's true, yes.
So,
yeah. Good point. Yeah.
Okay, all right, thanks everyone, and I will see most of you at the grad club, hopefully. All right, thanks Lars.